Is now a good time to invest in the stock market? You've heard the news. Now that a war is about to break out in some part of the world, now that the country is going into a recession, is going bankrupt, now that the government is doing something crazy which will definitely be bad for business, now that the stock market is on a downtrend, is it a good time to invest? Now the stock market is already so high, is now a good time to invest? This is the question that has always been asked by investors. So in this episode, we're going to answer this question once and for all. Well, not maybe for eternity, but maybe for the next 100 years. Is now a good time to invest in the stock market? Ready for the answer? It's a short one. The answer is yes. Now is always a good time to invest. Let us explain this. Here is the Philippine Stock Exchange Index, or the PSEI, since 1987 all the way to mid-2016. So this is the past 30 years of the stock market. Now, for those who are still new to investing, the PSEI is basically an indicator of where the whole stock market is going in the Philippines. So let's take a look at the chart. The first thing we would like to highlight is that it's so clear that the PSE in 2010 onwards was a lot higher than way back 1990s. So that's a 20-year difference. In fact, you could invest anytime 20 years ago and still you would be a very happy investor today. But of course, the stock market, it goes up and down because of various economic forces. And it's possible to lose money in the stock market. For example, if you invested during 1995 when the PSE index was around the 3,000 level, 5 years later in the year 2000, the PSE index dropped to the 1,500 level. So your money would have lost about 50% or more during that time. Same thing if you invested way back in 2007 when the PSEI was in the 3,500 level. Just 2 years later, in the year 2009, the PSEI dropped all the way down to just the 2,000 level. At this point, again, it was possible to have a negative 50% in your portfolio. Now, if these things happen, why do we say that now is always a good time to invest? Well, because we did an analysis with all of the data that we have. With 30 years of data, we wanted to know how much money you would earn if you just invested every month since 1987. So, what would happen if you just held on to it for various periods of time? What would happen if you invested it for a year, for 2 years, for 5 years, for 10 years, all throughout this 30-year period? So, for example, here are the computations we made. Let's say we buy in February 1987 and then we sell what we bought in January 1988. So exactly 1 year from the time that you bought. How much did that earn? Next, we buy again in March 1987, then sell that in February 1988. Again, it's a 1-year investment period. How much did that earn? Then we buy again in April 1987 and sell that in March 1988. And you continue doing this every month until today. How much would that earn? Now, we weren't really interested on the specific months and years here. What we were interested in were just 3 things. Number 1, the average annual return, meaning how much money did you earn on average per year. Number 2, the worst case scenario, meaning what would be the biggest loss that you would see. And number 3, the win rate, meaning how many times do you make money compared to how many times you lost money. So we were just interested in these 3 things. So if you blindly invested every month and held on to it for 1 year, what would happen? This is what we found out. The average annual return you would get on your money is about 12.8%. And the worst return you would ever get is negative 54.6%. The win rate is 65.5%. So you won roughly 2/3 of the time. So let me repeat that. If every month since 1987 you invested and you just held on to that investment for 1 year, your average annual return would be 12.8% per year. And your worst investment, your worst year, you would have negative 54.6%. And you would be making money roughly 65.5% of the time. Now, we didn't stop here. We wanted to find out next what would happen if instead of holding investments for just 1 year, we would hold it for 2 years. So here's how that would work. We buy in February 1987, but we sell it in January 1989. So it's for a 2-year investment period. How much did that earn? Then we buy again in March 1987 and then sell that in February 1989. Again, it's a 2-year investment period. How much did that earn? Then we buy again in April 1987 and sell that in March 1989, and so on and so forth. And you continue every month holding every investment for just 2 years. What kind of returns would we see? Well, here are the numbers. If you held on to your investments for 2 years, the average annual return you would get is 10.6 per year. The worst annual return would be negative 39.4% per year, and the win rate is 70.6%. Now take note here, the numbers I'm giving you are already annual returns. So because this is a period of 2 years, the average of 10.6% there means that you earned about 10.6% per year. So in total, that would be around 22%. Then with all of these numbers, we decided to go crazy. We continued computing for what would happen if we just invested not just for 1 year or 2 years, but what if the holding period was 3 years, 4 years, 5 years, 10 years, 15 years, and 20 years? What would be the average annual return? What would be the worst return? What would be the win rate? Well, here are the results. If you held on to your investments for 3 years, the average annual return was 9.7%. The worst annual return was negative 24.4%. And your win rate would be 68.5%. Let's fast forward to an investment period of 5 years. If you held on to your investment for 5 years, the average annual return would be 9.3% per year. The worst return would be negative 19.6% per year, and the win rate was 74.4%. Let's now do 10 years. Here, the average annual return is 6.4% per year, and the worst is just negative 7.6% per year, and the win rate is 71.7%. Now, at this point, I hope you're seeing the pattern, that the longer you hold your investment, the lower your average returns are, and this is expected because it's sort of normalizing with the good times and the bad. But what's more interesting is the worst case scenario. At the 10-year investment period, the worst possible thing that could happen is that you have an annual return of just negative 7.6%. Compare that to just having 1-year investment periods where the worst that could happen is you get negative 54.6%. So as you can see here, the risk is getting reduced the longer your investment period. Now let's continue. What if we held on to our investments for 15 years? The average annual return would be 5.1%. And the worst, it's already down to negative 3.3% only, while the win rate is 92.1%. Now, at a 17-year investing period, something very interesting happens. Here are the stats. The average return is about 5.4%. The worst return you can have is 1.5% return per year. Take note, that's a positive return. And the win rate, it's 100%. Meaning, if you invest in any period in the year 1987 or onwards, and you held that investment for a good 17 years, the worst thing that could happen was that you still earned 1.5% per year. So wala ka ng talo. Now, this continues to get better. What if you held on to your investment for 20 years? The average annual return is 6.2% per year. The worst that could happen, you would earn 3.1% per year. And your win rate, it's still 100%. With this data, there are two major lessons that I would like you to take away from this video. And they are crucial to your success in stock market investing. Lesson number 1, and this is very obvious and you probably know it already after seeing the data, and that's to be prepared to invest for the long term. Because when you invest for the long term, your chances of losing go to 0. And according to the data, it was shown that if you stay invested for 17 years or more, you could never lose money. Now, the second lesson, this is a bit more hidden, and that is to invest consistently and regularly. As you can see, the average annual returns for investing in the stock market, even on short-term periods, are always positive. So even if you invested just for 1-year periods, your average returns would still be 12.8%. Of course, you wouldn't make money every year. You would lose money about 33% of the time. But that means you still made money 66% of the time. So as long as you're consistently and regularly investing, the numbers will be on your side. So is it a good time to invest now? Yes, if you're in it for the long term. And yes, if you're going to invest regularly. These are the two big lessons for successful stock market investing. And I know you've already heard of these before. And well, in this episode, the data proved it. Invest for the long term, invest regularly. Keep these two lessons in mind as you continue your stock market investing, and you'll definitely be able to invest profitably and with peace of mind. Hey there, J3 here. Did you enjoy this episode? If you did, well, there are two things you can do right now to continue your journey towards financial freedom and abundance. First is to subscribe here in the Pinoy Money Academy channel so that you'll get updates on our new episodes, so I can send you free training videos on everything and anything about money. Second, if you want more focused training on how to invest in the stock market, you can download our free report called the Stock Market Jumpstarter. It's where we answer the 35 most frequently asked questions by beginners about the stock market and more. This report is so easy to understand that even if you know nothing about stocks and investments, you'll understand this report clearly. It's certainly the fastest and easiest way to learn how to invest in stocks. You can download this report for free just by going to the following URL. It's pinoymoneyacademy.com/smj. Again, that's pinoymoneyacademy.com/smj. I look forward to seeing you in our next episode. Until then, always remember to work hard, work smart, and make your money work hard for you.